Okay, let's say you've got an extra £500 a month hitting your bank account. It's a great problem to have, and it's enough to seriously move the needle on your finances. But it also presents you with a choice that could define your wealth for the next 2 decades. On one hand, you could take that money and absolutely hammer your mortgage. It's the safe, guaranteed route that gets the bank off your back years early and gives you an incredible sense of security. Or you could take a different path, a riskier one. You could dive into the world of investing, where that same £500 a month could snowball into a huge fortune, but where you're also riding the wild ups and downs of the stock market. So, who gets richer? The mortgage overpayer or the investor? It's one of the biggest and most heated debates in personal finance. The internet is flooded with strong opinions, but what's often missing is a proper, real-world breakdown that respects both the cold, hard numbers and the human emotions that drive these decisions. That's exactly what we're going to do in this video. We're going to run the numbers on a relatable scenario, explore the psychology behind each choice, and build a framework so you can make the right call for your life. To do this, we'll use a clear example. You've got a £300,000 mortgage on a 25-year term. To make the maths clear, let's use a 5% interest rate. And you have that extra £500 a month to play with. We will map out, year by year, exactly what happens to your net worth in both scenarios. This isn't about finding a single right answer, because there isn't one. It's about giving you the tools to find your answer. So, let's get into it. Alright, let's start with path number 1, becoming a mortgage overpayer. People call this the guaranteed win, and it's easy to see why. There's no guesswork, no speculation, and no sleepless nights wondering if the market is about to crash. Your return is fixed, predictable, and totally reliable. So what does overpaying your mortgage actually do? When you make a standard mortgage payment, some of it pays off the interest you owe, and the rest reduces the actual loan, the principal. Especially in the early years, a painful amount of your payment is just interest. Overpaying is when you send extra cash to your lender and tell them to put it straight onto the principal. Every single extra pound you send chips away at the core debt. This has a powerful 1-2 punch effect. First, because your loan is now smaller, the interest you're charged next month is also smaller. Second, because you're clearing the principal faster, you're sprinting towards the finish line, shaving years off your mortgage. Here's the key takeaway. Overpaying gives you a guaranteed, risk-free return on your money that's equal to your mortgage interest rate. Let that sink in for a second. If your rate is 5%, every pound you overpay is effectively earning you 5%, because that's a pound you no longer have to pay 5% interest on year after year. And this return is tax-free, which is a massive, often overlooked bonus. In a world of volatile investments, a guaranteed, tax-free 5% return is incredibly appealing. Okay, enough theory, let's get into the numbers for our scenario. You have a £300,000 mortgage over 25 years at 5%. Your standard monthly payment is about £1,754. Over the full 25 years, you'd pay the bank a total of £526,200. That means you're paying a jaw-dropping £226,200 in interest. That's the cost of the loan. Now, let's bring in our secret weapon, the extra £500 a month. From day one, you decide to pay £2,254 a month instead of £1,754. You're on the fast track. By doing this consistently, the result is huge. Instead of taking 25 years, you'd pay off your entire mortgage in just 16 years and 8 months. You'd shave a massive 8 years and 4 months off your loan. You would be completely mortgage-free while the regular payer still owes over £150,000. And the interest saved? This is where the win feels real. By paying it off this fast, the total interest you pay plummets from £226,200 to £148,800. That's a direct saving of £77,400. That's £77,400 of your money that stays in your pocket, not the bank's. It's not a potential gain, it's a guaranteed saving. And it gets better. there's a side benefit many people miss: the impact on your loan to value, or LTV. That's the ratio of your outstanding mortgage to your property's value. The lower your LTV, the better the interest rate you get when you remortgage. By overpaying, you're crushing your LTV ratio. This means when your initial fixed deal ends, you could qualify for a much cheaper rate, saving you even more money. But look, the argument for overpaying goes way beyond a spreadsheet. For many, it's about something priceless: psychological freedom. A mortgage is the biggest, most intimidating debt most of us will ever have. It just hangs over your head for decades. The thought of getting rid of it is incredibly powerful. Imagine that feeling: waking up in a house that is 100% yours. No more monthly payment to the bank. That security is absolute. It means if you lost your job, your biggest single expense is already gone. That peace of mind, for many, is worth more than any stock market return. Plus, once that mortgage is paid off in our scenario, you suddenly have a colossal amount of cash flow. Not just the £500 overpayment, but the original £1,754 payment too. Suddenly, you have an extra £2,254 hitting your account every month that you can then channel into other goals, including investing. The overpayer isn't anti-investing. They just want to secure their home base before going on the attack. Just one quick but really important warning here: early repayment charges, or ERCs. Most mortgages, especially fixed-rate ones, limit how much you can overpay each year, usually to 10% of the outstanding balance. In our case, £500 a month is £6,000 a year, which is well within the £30,000 limit on a £300,000 loan. But you must always check the fine prints on your own mortgage. So the case for the overpayer is about certainty. It's a guaranteed tax-free return, a huge interest saving, and an unmatched level of security and peace of mind. It's a strategy for building an untouchable financial fortress. Okay, on to path number 2, the investor. This is the ambitious route, the path of taking a calculated risk to try and build even greater wealth. The philosophy here is totally different. Why take a guaranteed 5% return by paying down debt when you could potentially be aiming for 7, 8, or even 10% in the stock market? Instead of sending that extra £500 to the mortgage company, the investor puts it into an investment account. Now, we're not talking about gambling on meme stocks. For a fair comparison, we're talking about a sensible, long-term strategy: consistently investing in a low-cost, globally diversified index fund. Think of an index fund as a shopping basket, holding a tiny piece of hundreds of the world's biggest companies. You're not betting on one company. You're betting on the global economy to grow over the long term. And history shows that's been a pretty good bet. The secret weapon for the investor is the magic of compound growth. Einstein supposedly called it the eighth wonder of the world. Unlike the straight-line progress of paying down debt, investment growth is exponential. Your money earns a return. The next year, you earn a return on your original cash and the returns from last year. It's a snowball effect that starts slow but can turn into an avalanche of wealth. So let's run the numbers for the investor. They're still paying their standard £1,754 mortgage every month, but the extra £500 goes into a stocks and shares ISA where all the growth is completely tax-free. We need to make an assumption about the average annual return. The historical average of the stock market is around 10% a year, but it's always smart to be conservative. So to be safe, let's model two outcomes: a cautious 7% average return and a more optimistic 9%. Let's use the same point in time: 16 years and 8 months, 200 months, which is when the overpayer becomes mortgage-free. Where's our investor at this moment? Investing £500 a month for 200 months. At a 7% average annual return, their pot would be worth about £183,000. At a 9% average annual return, that pot would be worth about £227,000. That's a serious pile of cash. But hold on, the investor still has a mortgage. After 16 years and 8 months, their original £300,000 mortgage would still have around £128,000 left to pay. So, at the exact moment the overpayer is celebrating being debt-free, we calculate the investor's net position by taking their investment pot and subtracting their remaining mortgage. In the 7% scenario, £183,000 investments, £128,000 mortgage equals plus £55,000. In the 9% scenario, £227,000 investments minus £128,000 mortgage equals plus £99,000. And right here, this is the mathematical heart of the argument. On paper, at the very moment the overpayer achieves their main goal, the investor is already significantly wealthier. But the case for investing has other aces up its sleeve. The first is liquidity. Money paid into a mortgage is locked up in bricks and mortar. It's hard to get back without selling or remortgaging. The investor's money, however, is liquid. If a real emergency hits, they can sell some of their investments and have cash in the bank in a few days. This flexibility is a different, but just as valid, kind of security. The second advantage is inflation. Inflation slowly eats away at the value of money, but for someone with a big fixed debt, it's a secret friend. The £300,000 you borrow today will feel like less in 20 years because wages and prices will have risen. The investor lets inflation gently shrink the real value of their mortgage while their investments are hopefully growing faster than inflation. And finally, let's talk about the ultimate cheat code for UK investors: pension contributions. If our investor puts that £500 a month into a private pension, a SIP, instead of an ISA, they get tax relief from the government. For a basic rate taxpayer, every £400 you put in, the government adds £100. That means you only need to give up £400 of your pay to get £500 invested. It's basically free money that turbocharges your returns before you've even started. Research from big platforms like Vanguard shows that when you factor in this tax relief, investing almost always wins against overpaying a mortgage. Of course, this path has real risks. The returns are not guaranteed. The market is volatile, and there will be years when your portfolio drops. It takes guts to keep investing £500 every month when you see your balance go down. The biggest risk isn't a market crash. It's panicking and selling at the bottom. This path requires patience. So the investor's path is about taking a calculated risk for a higher potential reward. It uses compounding, liquidity, and tax breaks to try and build the biggest possible net worth. Okay, we've seen the theory. Now it's time for the main event, the head-to-head showdown. Who is actually richer at the end of the original 25-year mortgage term? And this is where it gets really interesting because a lot of comparisons forget a crucial step. What does the overpayer do once that mortgage is gone? We need to factor in their snowball moment. Let's set the 25-year race clock. The investor's journey. The investor's plan is dead simple. For 25 years, they pay their £1,754 mortgage and invest £500 a month. At the end, their mortgage is paid off. The house is theirs, and they have a massive investment pot. After 300 months of investing £500, at a 7% average return, their final pot is worth about £407,000. At a 9% average return, their final pot is worth about £563,000. At the 25-year finish line, their wealth generated from this decision is between £407,000 and £563,000. The overpayer's journey, the snowball scenario. The overpayer's journey has two parts. Phase 1, first 16 years and 8 months, they hammer the mortgage with an extra £500 a month. At the end of this phase, the mortgage is gone. They have £0 in investments. Phase 2, the last 8 years and 4 months. The snowball moment. They are now totally mortgage free. Their entire old mortgage payment, £1,754, plus their old overpayment, £500, is now free. They take this whole chunk, £2,254 per month, and start investing it for the remaining 100 months. So what does the overpayer's pot look like at the 25-year mark? They invested a bigger amount, but for a much shorter time. Investing £2,254 per month for 8 years and 4 months at 7% gives them a final pot of about £311,000. Investing £2,254 per month for 8 years and 4 months at 9% gives them a final pot of about £343,000. The final verdict at 25 years. Let's put them side by side. Participant wealth generated, 7% return. Wealth generated, 9% return. Investor, £407,000, £563,000. Overpayer, £311,000, £343,000. As you can see, even when the overpayer starts aggressively investing later, the investor who started from day one comes out way ahead. The difference is a staggering £96,000 in the 7% scenario and a monumental £220,000 in the 9% scenario. So why the huge gap? It all comes down to the raw, undeniable power of time and compounding. The investor's smaller amount of money had 25 years to grow. The overpayer's bigger amount only had about 8 years. The first 15 years of compounding are where the magic really happens, and the overpayer missed them. Based on pure maths, the investor wins. But, and this is a big but, this result isn't guaranteed. It's super sensitive to a few key things. The interest rate. We used 5%. If your mortgage was at 7 or 8%, the guaranteed return from overpaying is far more attractive, and the gap between the two strategies shrinks or even reverses. On the flip side, if you're lucky enough to have a 2% rate, the argument for investing is overwhelming. Investment returns. We used 7% and 9%. What if the market goes nowhere for 10 years? If the average return was only 4%, the overpayer with their guaranteed 5% return would look like a genius. The risk of the market underperforming is real. Your time horizon. A 25-year race is perfect for the investor. But what if you want to be debt-free in 10 years to change careers? The certainty of overpaying might be much more valuable to you. This shows that while investing often wins on a spreadsheet, the real world is a lot more complicated. So far, we've treated this like it's a black and white choice. You're either team overpayer or team investor. But what if it isn't? For many, the smartest path is right down the middle. This is the hybrid approach. The logic is dead simple. You just split that extra £500 a month. Maybe £250 goes to the mortgage and £250 goes into investments. The main benefit? You're hedging your bets. You get a piece of the stock market's potential growth so you don't miss out on compounding. But you're also making real progress on your mortgage, which satisfies that need for security. You get a little peace of mind and a little wealth building. This approach can be really strategic. For example, you could use it to hit a lower loan-to-value LTV band faster. Remember how that gets you a better remortgage deal? A savvy person might calculate exactly how much they need to overpay to hit the next LTV band just in time for their fixed deal to end. They put part of their £500 towards that and invest the rest. Once they've secured that new, lower interest rate, the guaranteed return from overpaying drops. At that point, they might pivot all £500 into investing, because the maths has become even more compelling. This is a more hands-on approach, for sure, but it lets you get the best of both worlds. It's the middle road, and in finance, the middle road is often the smartest place to be. Alright, we've run the numbers, we've looked at the psychology, we've seen the investor win on the spreadsheet, and we've felt the emotional pull of the overpayer's secure fortress. So, after all this, who really gets richer? The truth? The person who gets richer is the one who picks a strategy and actually sticks with it for the long haul. The best plan in the world is useless if you can't emotionally handle it. The real winner isn't decided by a calculator, it's decided by you, your personality, your stomach for risk, and what you actually want out of life. To find your answer, you need to figure out which of these camps you fall into. First, there's the fortress builder. This is the overpayer. For them, security is everything. They want to eliminate risk and sleep well at night knowing their home is theirs. They hear 9% market returns, and all their brain processes is potential for loss. The guaranteed 5% return isn't just a number, it's the feeling of solid ground. If rich to you means being rich in security, overpaying is your path. Then there's the wealth maximizer. This is the investor. They're playing to get the highest score. They're comfortable with calculated risk because they know it's the price of long-term growth. They see a 5% mortgage as cheap leverage to get a potential 9% return. They have the discipline to ignore the scary headlines and keep investing. If rich to you means having the biggest possible net worth, investing is your path. Finally, there's the balanced strategist. This is the hybrid. They see the wisdom on both sides. They want a smaller mortgage, but they also get FOMO thinking about missing out on compound growth. They're pragmatists who know that a balanced approach is often the most resilient. If rich to you means making steady, sensible progress on all fronts, the hybrid approach is for you. So the question isn't who gets richer, it's how do you define rich? Before you do anything, get the basics right. This whole debate is pointless if you have credit card debt at 20%. That's a 5-alarm fire you need to put out first. And you absolutely must have an emergency fund of 3 to 6 months of living expenses in cash. That's your safety net. Once those are sorted, ask yourself, what's my actual mortgage rate? The higher it is, the better overpaying looks. What's my real tolerance for risk? How would I feel if my £50,000 investment pot was suddenly worth £35,000? How much do I truly value the feeling of being debt-free? Is it a nice idea or a deep-seated need? What's my time horizon? Are you 25 years from retirement or 5? The longer the runway, the more risk you can take. The point of this video wasn't to give you the answer, but to give you a framework to find your answer. Run your own numbers with your own rate and have an honest chat with yourself about what truly matters to you. That's the only way to find the path that will make you richer. Look, this debate is deeply personal, and there are millions of smart people on both sides of the fence. The key is to make a conscious choice, not just drift into one. Now, I'm genuinely curious. Where do you stand? After all this, are you on Team Overpayer, Team Investor, or Team Hybrid? Let me know in the comments. I read them all, and I'd love to hear your strategy and why you chose it. And hey, if all this has you thinking the investor path might be for you, but you're not sure where to start, you're in luck. The next step is to learn how to build a simple, effective portfolio. To help with that, click here to watch my next video on the absolute beginner's guide to investing in index funds, where I break it all down step by step. Thanks for watching.